The opinions expressed are those of the host. The material is for informational purposes only. It does not constitute investment advice, and it is not intended as an endorsement for any specific investment. Visit crestmontpw.com for more details.
This is the Ascent with Crestmont Private Wealth. I'm Alec Walker, coming to you from our studio here in Houston, Texas, broadcasting out in the Hill Country in Boerne. The conversation that we wanted to talk about today, as we've kind of rolled over into the new year, is a little bit about our current market and current economic environment. We've just over the last week and a half done our Q1 quarterly investment committee meeting here at Crestmont Private Wealth, and that's where our investment committee team huddles. We review current economic conditions, look at the macro environment. We're reviewing our individual portfolio holdings, how they performed last year. Do we need to make any changes going into this year? And as you can imagine, a lot of discussions, coming out. It's a pretty unique position in the current environment. Markets are at or very near all-time highs, depending on when this recording goes out. This is being recorded on January 15th. And it's been quite a bull market run over the last 3 years. Markets have really recovered from the lows that they set, which was about October of 2022. And throughout that time, we've done various changes, tweaks. And right now, the main consideration we've got is it time to rebalance? From a risk perspective, then we maybe wanted to, based on that client's particular goals or that strategy's particular objectives. Do we need to, quote unquote, sell some of those winners or outperformers and rebalance to more conservative or less risky investments? May that be cash or bonds within the portfolio. But I wanted to kind of talk a little bit more broadly about being at all-time highs and investing at all-time highs. A lot of folks can get kind of nervous, and rightly so, about putting money to work when the market is at an all-time high. They see it's kind of like, standing at the top of a mountain. You can see only one way down. You can only see where you've come from, but you can't really see where things could go. And if we just zoom out, like I said, a few years ago, the market's gone on it. Over the last 3 years, we've continued to hit new all-time highs and new all-time highs. And if you weren't participating in that growth, in that long-term compounding, well, that can actually set you up for the future to be in a more difficult situation. So I wanted to share a few data points. This one's coming from Dimensional Fund Advisors. So this is looking at the average annualized returns of the S&P 500 index after a market hits an all-time high and after a market experiences a 20% decline. So 1 year later, after the market hits an all-time high, the average return of the S&P 500 is 13.9%. going back to 1926. Now, comparatively, after the market falls 20%, where you may think, oh, okay, things are on sale, this is a good time to buy, the market on average is only up 11.6%. And the same thing is true 3 years later. After an all-time high, the market is on average up 10.5%. Of course, past performance is no guarantee of future results, but it tends to seem historically that all-time highs, positive market movement, positive growth tends to lead to future growth going forward. One of the things that we looked at pretty closely in our investment committee was talking about valuations. And that's a terminology that is thrown around a lot in the markets. You'll hear valuations are very high in the stock market. Valuations are very high in the S&P 500. So what this is the price that investors are paying for the forward earnings, for the future earnings of those companies. And yes, it is very true that valuations are well above their long-term averages. But if we take a look at some of the data, just to kind of put my statistics hat on, get a little nerdy here. When you're looking at the correlation of current PE ratios to future returns, so kind of the similar conversation we were just talking about is, okay, the market's at an all-time high. What does it look like going forward? Well, just because valuations are high, does that mean the correlation for returns over the next 12 months is going to be, can we predict what that's going to be? And the correlation, or the R-squared number, is actually pretty low. That's 5%. That means there's almost no correlation that today's valuations we can project where the market is going to be 1 year from now. To put that in perspective, the correlation of Alec waking up in the morning and having a cup of coffee is about 99%. That means I'm having a cup of coffee. You can count on that. So comparatively, 99% Alec's having a cup of coffee to the market is highly valued. It's 22.3 PE today. Well, there's only a 5% correlation of what that means for future returns going forward. Very, very low by comparison. So as we kind of talked through this in our investment committee, it's just really not a data point that we can rely on to try to predict the future and market performance. So that just tells us, hey, it's time to stick to the plan, stay diversified, and make adjustments as we proceed forward. You're listening to the Ascent with Crestmont Private Wealth. I'm Alec Walker. Today we're talking about the current economic and market environment. One thing to mention, we sent this out in our newsletter last week. We're going to mention it again in another newsletter. If you want to sign up for our newsletters, please send us an email via info@crestmontpw.com. Happy to add that to that newsletter. Generally, we send out 2 market newsletters per month every other week, and probably 1 or 2 additional that are more financial planning focused newsletters. So the chart that we had just sent out in this last newsletter, we call this the red dot chart. Comes from our friends at JP Morgan Asset Management. They put together some great visuals and great charts that are updated on a daily basis. And what this chart shows, it shows the performance of the U.S. stock market, the S&P 500, going all the way back to 1980. And the return of that stock market is the gray bar. So in a positive year, we've got a positive gray bar. A negative year, we've got a negative gray bar. The red dots that show up on that chart, which those red dots show up every year, shows the largest drawdown in the stock market in that given year. So it could be, if we're just straight up on a year, it could be 0 on that red dot. But if it was like last year, where we experienced a 19% decline in the stock market, we're going to see that big negative 19% dot on that market. But as we know, the market actually finished up 16%. So that was nearly from the bottom in April of last year to where the market finished in December was nearly a 40% swing. So imagine, had you sold at the very bottom and never got back in because you were concerned about the risks that were out there, uncertainty about tariffs, uncertainty about interest rates, concerns about the over-reliance of the stock market on the returns of these large 7 tech companies. Had you stayed out of the market, that could have been nearly a 40% delta in your portfolio. But the key stat on this chart that we always say is those declines on average since 1980 are about 14%. So even though we're at all-time highs this year and things may be, we feel positive at what we've done the last 2 to 3 years in the market, we're always telling clients we should expect volatility. We should expect a 14, 15% drop in valuations. And if that occurs, that doesn't just mean we're going to, put our hands on our hips and stand there and just wait for it to recover. No, there's a lot of things that we can be doing when there's volatility. We can be rebalancing, as I mentioned at the top of the call, to make some changes. We could be harvesting losses in our portfolio, which is something that we did last year in some of our satellite strategies. So it's not just wait and see for that volatility. It's also reacting and making adjustments as that volatility occurs. So I touched a little bit on AI and the Magnificent Seven, and this is something that a lot of clients have had questions on. When you look at the data on these companies, yes, they attribute a large percentage of the growth of the S&P 500 over the last few years, but those remaining kind of 493 companies, they've started to show some positive movement as well. The concern that most people have, and rightly so, is those Magnificent Seven companies, they make up about 33 to 35% of the S&P 500 valuation. And so if you just own one S&P 500 ETF or one S&P 500 in your 401k, yeah, it's true, your portfolio is allocated to those 7 companies. But what we try to tell our clients, and why we try to be a bit more globally diversified, a bit more broadly diversified, is we don't just own the S&P 500. Yes, it is a large allocation of our core portfolios, but we also have mid cap, we have small cap, We strategically added a fund last year that excludes the S&P 500. It starts with the 501st largest company and works its way down from there, because we wanted more exposure into the mid cap and small cap sector. And then, of course, we've got international and emerging market stocks as well. So when you add all those different elements just to the equity portion of the portfolio, so that's not even factoring in if you've got a more conservative portfolio that has 10, 20, 30, 40, 50% of fixed income or bonds in the portfolio. But just looking at the equity portion, our equity portion of our portfolio is around 23% allocated to those Magnificent Seven companies. So a significant difference in allocation compared to just owning the index. And if you look at our satellite strategies, these strategies own individual stocks. Those are going to be even less allocated to those companies, and those are going to be more equally weighted with some drift. The final piece that I just wanted to touch on in kind of the current market environment, things that we looked at, is talking about consumer confidence. So surprisingly, maybe not so surprisingly, because I think there are some elements out there that are warranted. We're entering a midterm election year. We talk about politics a lot and trying to separate politics from portfolio. It sounds cliche and tried and true, but statistically, that is the best method. Politics are going to cause some consumers, some investors to be more confident than others. We're obviously going through a big technological advancement or revolution potentially with AI. And for many folks out there, there's potential disruption for their job and for their livelihood. So that could cause a lot of discomfort or lack of confidence. And so actually we are the latest reading, January of 2026. Consumer confidence is not that much higher than it was in June of 2022 when we were going through one of the worst market years since 1976, where stocks and bonds were both down double digits that year. We're actually not that much higher than where we were in 22. But historically, what that means when we're looking at this consumer confidence chart tracked to the S&P 500, on average, when consumer confidence hits one of those troughs or hits one of those low points, the subsequent 12-month S&P 500 return on average, going back to 1971, is actually 24%. So just kind of a recommendation is, just because things may seem really bad, especially when you're looking at we've got our phones providing news and the algorithms, things can seem negative and down, but know that your portfolio, as we explain to our clients, we like to say we're investing in businesses. So political noise that's out there that we can't control, we try to keep our portfolio separate from that. If you have any questions, I encourage you to sign up for our newsletter. Please reach out to us via info@crestmontpw.com, or you can visit our website at crestmontpw.com to learn more about our company. Thank you very much. Have a great weekend.